Good morning, everyone. Thank you for joining us. I'm James Ridley from the Atlas Wealth Management, and I'm joined today by my colleague, Specialist Financial Planner Martin Jack, as well as Josh Ashman from Expat Tax Professionals in the United States. Today's session is about one thing: coming home. If you've spent years building a life in the United States and you're thinking about coming and moving back to Australia, there's a financial and tax layer to that move that most people underestimate. We're going to walk you through the steps to take before you leave, as you're coming back, and after, because the order you do these in genuinely matters. We've structured this in two parts today. In the first part, Atlas will cover the strategy in the wealth side and talk a little bit about the Australian tax treatment. We'll talk about the sequencing, the assets, and then Josh will take it over and walk us through the US exit tax side, which is where things get super technical. So let's get into it. Quick bit of housekeeping. Before we start, everything you hear today is general in nature. It should not be taken as personal financial advice or personal tax advice. We don't know your specific circumstances, objectives, or needs, so please don't act on anything you hear today and treat it as tailored to you. If something resonates, and it probably will, the right next step is actually a conversation with a qualified advisor, a tax accountant, or a tax lawyer who can look at your actual situation. With that said, let's get into it. A quick word on who the Atlas Wealth Group is and who we are. For those who haven't come across us, Atlas, we are a leading provider of financial advice, tax and mortgage services built specifically for Australian expats. That's our whole focus: globally mobile Australians and cross-border families. We're regulated by three different regulators at the moment: ASIC, ATO, and the DFSA, and in the future that will continue to climb. We look after clients in more than 50 countries. Once we got to 50, we just stopped counting. It seemed like a nice round figure. We manage over 500 million in assets, and importantly, every one of our specialists holds a degree with postgraduate certifications. This isn't a generalist shop that happens to take expat clients. We cross-border is what we do every single day. Here's how we're going to spend our time together, running through the agenda. Firstly, repatriation planning, why coming home is a financial event in its own right, and what a good outcome actually looks like. Then the heart of the Atlas section, the three phases of repatriation, from planning decisions 12 to 24 months out, the critical pre-residency window, and then your first day back as an Australian tax resident. And then lastly, I'll hand it over to Josh, who'll take you through the US exit tax, whether you're even caught by it, the three tests that matter, and a couple of real case studies. We'll have times for some questions. So before we move into the next couple of slides, if you do have any questions, there is that question box. So please drop it in there. I can see some people acknowledging it, putting their hand up. They can hear us, which is great. So as we move through it, I'll collect those questions, I'll summarize them, and then we'll open up the floor at the end for a bit of Q&A. In the meantime, let's jump into it. Coming home is a financial event. So this is our core idea. When you've built a life up in the United States, you leave a financial footprint on both sides of the Pacific, in the US and Australia. Repatriation is that moment those two systems collide, and the order in which you act can genuinely be worth more than the actions themselves. Three things that drive this. Firstly, you've got two different tax systems that are coming together on one timeline. The US calendar year and the Australian financial year, they rarely line up, and that mismatch creates both traps as well as opportunities upon your repatriation. Second, assets in the wrong place. A lot of US accounts and structures that made perfect sense while you're living there permanently become expensive or awkward once you've back in Australia and you continue holding them. Thirdly, residency changes everything. The way your tax shifts the very day your residency does. That's the thread that we're running through the whole deck: what to do before you leave and what to do after you have arrived back in Australia. What a good outcome looks like, summarizing it. So one, avoiding unnecessary tax on both sides simply by acting in the right sequence. A lot of tax leakage in these moves isn't inevitable, it's a timing problem. Two, protecting what you've built. So bringing your wealth home without triggering avoidable tax events along the way. Three, re-establishing yourself back in Australia and doing it properly. So getting your super investments and your structure set up for the long term, not just patched together on arrival. And lastly, number four, it underpins it all, clarity and confidence. You want to know the plan before you board the plane, not be figuring it out after you've landed. That's what the rest of today is designed to give you, that plan. With that in mind, I'll now hand it over to Mr. Martin Jack to take us through the core of the heart for Atlas. Over to you, Martin.
Thank you very much, James. I think you provided a very good summary there. So, good segue into the three phases. There's certainly a lot of steps in repatriating to Australia. Everyone's circumstances are unique, and whether or not you're just from the US or maybe you've got assets everywhere. So, we have tried to condense it into three core phases today. So, we'll go through them and save you questions towards the end. But let's jump into the first one, which James has already sort of touched on, and it's your single biggest and most valuable lever, which is pre-residency planning, because that's what we actually have in our control. The moment that we come back to Australia, we've effectively lost that lever. Pre-residency strategies, they do have that expiry date, and missing that window, you completely lose that lever altogether. So we need to make sure that any decisions that we make, they're done ideally years in advance, but at the very least 6, 12 months in advance. And there's a few events that come off the back of that, from triggering deemed acquisition, understanding that you're dealing with two different tax systems, two different tax years as well. So aligning the two or optimizing the differences there too. Working with people like Josh to coordinate US exit tax, and also have that extra control with your employer from negotiations too. Whether that's RSUs, whether that's final bonuses, when are you going to receive that? Can you move back? Can you touch your 401k and make some changes to that before you come back to Australia? A lot of this needs to be done prior to coming back. FX strategy as well. And maybe one of the biggest ones, and probably the one that comes to your mind first and foremost, is, well, my family, and actually planning for that as well. So schools, leases, getting the dog back, that could take 6 months to send your pets back to Australia. So we need to have a clear runway ahead of us and a timeline ahead of us that we can actually pull the trigger on all of these different events. So understanding first and foremost the decision to, will I come back to Australia? Yes. Okay. Next, the timeline. Is that in 2 months? Hopefully not. Is that in 12 months? Ideally, and longer than that, the better, realistically, especially the more assets and the more complex your global family is, really. So once we have phase one and we've decided our timeline and we decided we're definitely coming back to Australia, then we can start moving into the pre-residency planning window, which is phase two. So I'll just get you to flick across the next slide there, please, James. Beautiful. So the first point is to understand that your Australian tax residency start date is one of the most important dates in the entire move. Before that, we have the level of control that we need to either choose to sell, restructure, withdraw accounts, distribute from accounts, convert funds, whatever it might be. It's all under your control. Once you're back in Australia, you're an Australian tax resident, deemed acquisition applies, which means that every asset naturally falls under the ATO tax net there, so your worldwide income's accessible. And what this means is that every single asset that you have, it needs a decision, and it needs a decision before you come back. Are we selling? Are we restructuring? Are we holding? Or are we going to withdraw? So the first step that we do here is actually capture your balance sheet. So that's the very first step after phase one, pre-residency planning. What do I own? What's going to be captured upon this return to Australia? Is that going to be, the FX, the cash I have, US shares, RSUs, property, HSAs, all of these different vehicles and probably different type of accounts that you've accumulated for building your life and building your wealth over in the US. Once you have a good understanding of that balance sheet, we can go and start making some decisions there. Now, those decisions come down to understanding, well, how does the ATO treat it and how does the US system treat it as well? So we'll go through a couple of these core ones now, but obviously there's a lot in here. So, we won't be able to get through them all, but we'll see how we go. James, if you could flick to the next one, please. One of the biggest ones I think that comes front and center of everyone's mind is a retirement account. How are these taxed both in the US when I leave and then also in Australia? So, you probably have moved to the US, you probably got offered a 401k, or you heard all about the Roth accounts and started out into a Roth IRA as well. And these are great for US retirement accounts, but that decision comes around when we leave around what to do with it. So I always try to start with understanding, well, what's going to happen when I come back to Australia? And it's important to understand that Australia doesn't recognize a 401k as a 401k as it's designed in the US. They recognize it typically under Section 99B of the tax law. Very boring read, but usually foreign investment trusts. And what that means is they break it into two core components. So they see one lens of it as what's called the corpus, fancy way of really saying capital, generally speaking. I mean, it's basically all of the contributions that have gone into the account, any employer matching contributions, any of your personal contributions. This would apply to things like your Roth or your 401k as an example. Now, all of that makes up the corpus, which means that the remaining balance makes up the earnings component. Now, when we come back to Australia, that is seen under Section 99B, and that means that it's taxed slightly different. So the corpus is tax exempt here in Australia, but the earnings component is taxable here in Australia. So it's taxable not at capital gains tax rates, it's taxable as ordinary income. So you do need to figure out the balance sheet there. You need to make sure that you have historical data to track that. Should you ever get a tap on the shoulder by the ATO to say, okay, well, how do you know how much is corpus? Well, you've got the evidence there. There are things that you can do before you come back to Australia as well to make it more tax efficient too, from Australian tax purposes. But it does mean that you have to navigate both systems, because if we're looking at a 401k as an example, and one of these questions I have on the slide here is one account more favorable than the other? So we have a 401k, you pay tax deferred taxes over in it's tax deferred vehicle. So you pay taxes when you make a distribution over there in the US, and you have a Roth where you don't pay taxes, assuming you meet all of the conditions, and that comes out. But here in Australia, they're really both captured under that Section 99B treatment, foreign investment trust. So basically, if you're looking at, well, which one's going to be more effective? I mean, a Roth has gone in after tax, and then it comes out, you pay no US taxes, but you end up paying Australian taxes. So a Roth, is it favorable to keep that if you're retiring here in Australia, or should you consider maybe winding that up, or changing to a different vehicle before you come back? So you need to start asking yourself these questions as they arise, and that way you can make decisions around, is it worth keeping my 401k, or should I cop the extra penalty tax? Is it worth keeping the Roth account, or can I better use that to free up the capital and buy a property or put it into my superannuation when I come back to Australia? Another retirement account, or a retirement benefit, I should say, that we often get asked is Social Security. Can you keep it? Yes, as long as you're entitled to it, as long as you met your 40 credit points, which is about 10 years worth of contributions for credit points per year. And obviously then you get that. And the beauty of that is it's actually not taxable here in Australia. So it's one of those really, really unique carve-outs in the double taxation agreement where it's completely tax exempt in Australia, which is fantastic. Naturally, in the US, there will still be some withholding tax to pay over in the US. But understanding how is the retirement account taxed in the US, and just because it works in the US system doesn't mean that it's going to work in the Australian system. So that comes down to that balance sheet, understanding, do I sell, do I withdraw, do I restructure? So understanding that pre-planning option there. Moving forward into some more foreign assets. You just flick to the next one there, please, James. Currency. Look, when you move back to Australia, there can potentially be a Forex event realization one, or Forex realization event one. This comes under the FX currency. Is there a capital gain? Generally, though, if you just move the money over, it's pretty exempt. It's a bit of a risk, though. Naturally, if you've built all your wealth in US dollars and then you come back to Australia and then suddenly the US dollars dropped and weakened significantly against the AUD, you're at a bit of a risk. So that pre-planning, should I start moving money back sooner? Should I start dollar cost averaging and building more wealth in AUD? If that's my home and that's where I should be spending that money, then it could make sense. Understanding that your US shares, RSUs, and former employer stock fall under the deemed acquisition rules here in Australia, which means they effectively get reset for cost-based purposes or for tax purposes. So that can go for and against you. So if you've got a massive unrealized gain, you beauty, come back to Australia, There's a step up in cost basis. You pay no taxes to the ATO on the history of that gain. Albeit if you're still a US citizen, still US connections, you might have some US taxes when you pay that. But from Australian purposes, if you've got some losses, then there's a step up in cost basis. Those losses are gone forever as well. You don't get to carry them forward here in Australia. So if you do have some losses, it might make sense to, in the years that you are earning income, start to utilize those losses then. So start to realize those losses so they're not just disappear into the ether. Property, it's a big decision as well. What are you going to do with your property? Are you going to keep it, in the US? Are you going to turn it into an investment property? How is it taxed here in Australia? What about in the US? So in Australia, typically, even your foreign property can get the main residence exemption, and in some instances, the 6-year temporary absence rule as well, which means it's less critical for Australian taxation concerns. But tread carefully because it can go wrong very quickly too. In the US, be mindful of if you are turning it into an investment property. There is sort of 2 in 5 rule. So have you lived in it in 2 of the last 5 years? Then you could still be entitled to the $250,000 principal place of residence exemption. So be mindful of that clock and when that starts. Naturally, you need to make some decisions. And also, it's a very big asset. You also become a foreign owner of this investment property, and that can complicate things, especially if you've got debt. Currency comes into play, tax legislation change risk comes into play, inheritance tax comes into play as well. So it can be very messy if you continue to hold US property as a non-resident owner, basically. HSAs, 529s, and covered Ls. There's a lot that goes into these. Typically, they fall under that Section 99B foreign investment trust treatment. I'll just talk about mainly I'll talk about the HSAs and the 529s. HSAs, you can't really use that as a medical expense here in Australia. It doesn't really work that way. So if you're going to use it, try to use it all whilst you're in the US, or you're probably going to end up copying some extra penalty taxes there, unfortunately. So be mindful of how much you add to that in the lead up, and then when you start accessing that. 529s, pretty good actually. You can use that in some qualified institutions here in Australia. So as an example, New South Wales, Sydney, New South Wales University, you can use it there. But obviously check which provider. So just check all of that. Make sure that where you intend to spend it, where your children intend to utilize those funds, it's classified as a qualified institution. US trusts and companies. This is a very, very complex area of tax law, and there can be good cases and bad cases. And very, very common in the US to just have a living trust for asset protection purposes tied to your social security number. You can't just retain that and come back to Australia and think it's all going to go just as good and it's all going to flow through to yourself, because it's not. Trusts in Australia are very, very different to the US. They are separate legal entities, and if you hold that, you come back to Australia, then it can fall under Section 99B treatment again. You potentially can get the step up in cost basis, and in some instances, potentially not. So if you have a very large brokerage account, you could be exposing yourself to extra taxes. But pre-planning, maybe unwinding that or getting a formal tax ruling on the treatment of that and the assets inside can help you, save, in some instances, a significant amount of tax. So complicated area. Make sure you seek advice from the professionals, especially in that area too. We'll jump across to phase 3 now. So phase 1, decision timeline. Phase 2, all about actually actioning, using that lever whilst we have it before we arrive in Australia. Now, day 1, back in Australia, we typically become Australian tax residents, and that's when there is this hard switch. And that's because your worldwide income and all your assets are now captured by the ATO as well. The deemed acquisition, I've talked about that a few times. I'm sure you guys have probably read online as well, perhaps, about that. But basically, it's when you're deemed to have acquired all of your assets on the value of the day that you stepped off the plane and commenced tax residency. So that becomes a new cost base for all of your assets, and naturally, you have to record that for future CGT events. Really important to document everything. If you can't prove the value, if you can't prove the corpus, then you're not going to be able to get it across the line if you get audited with the ATO or when you submit it with the ATO. You need to have that evidence behind you. So get account statements, get property valuations, get the FX rates as well, so that we don't have a massive FX currency gain, and when we transfer money back to AUD, and now you're paying capital gains tax as well. So we need this evidence, and one afternoon of account statement tracking and record keeping can save you days and days and years and potentially heaps of tax in the future as well, especially things like 401ks if you're a young investor and that's 30 years away. Remember that deemed acquisition don't have all assets reset, like assets inside of US trusts, as I mentioned previously. So this is why that pre-residency planning is core. Now, it's not all doom and gloom, because when you come back to Australia, we do have some really good planning opportunities. So, James, I'll get you to just flick to the next one here, please. Great. It does open some doors as an Australian tax resident. And I think one of the biggest advantages is that the fact that it gives you a very clean slate. It's very rare that someone can come back to Australia, have their entire assets have a step up in cost basis, or move a significant amount of wealth down, free up all of this capital, and then be free to do whatever they want. They're not tied to a plan when they were 20 years old and slowly accumulating that they have this fresh start. And that opens many doors, and that opens doors to things like Australian entities. They're back on the table. Usually they're off the table whilst we're in the US, but family trusts are back on the table. PTY LTDs are back on the table, and they can work properly if you are no longer a US tax resident. So maybe considering those entities as part of your ownership, things like buying property and debt recycling off the back of that work really, really effectively here in Australia. And maybe one of the most common ones here in Australia that a lot of Aussies take for granted, but that's superannuation. You've probably, if you've lived overseas for 10 years, probably forgot all about it. You probably let it just sit there and sit behind you and built your 401k. And that's very normal, very common, especially when you deal with the complications that the IRS gives to superannuation. But it wakes up, and there's a lot of different strategies you can do. If you were timing it over 2 Australian financial years, June, July, you could squeeze over $1 million into your superannuation over a course of 2 months. If you're a spouse, you got a spouse, that's $2 million. If you sell your US property, you got all this capital. Now you've moved $2 million into your $1 million into your respective superannuation accounts, and then you can transition to retirement completely tax-free withdrawals, tax-free growth, tax-free earnings. Fantastic. You can move more than that in if you've got carry forward concessional contributions as well, so you save some more taxes at the same time. But it really does wake up and becomes a real key pillar in your retirement strategy if you've left it dormant. And that can come in the form of saving taxes or just simply boosting it for your retirement account. Final one here will be a US Australian repatriation checklist. Basically, a bit of a take-home roadmap. Make sure that you time your income carefully. Bonuses, RSUs, deferred comp, these can be sequenced across both tax years. So we didn't really talk about that too much, but think about how Australia taxes things like RSUs versus the US, and then also the differences in marginal tax rates as well. A lot more favorable generally in the US to receive these, especially if you're doing it, say, in January or February, where you haven't earned much income for that year compared to a full year and departing in December, as an example. Executing your FX strategy, don't leave everything up to chance. It's just a risk you shouldn't necessarily take. So transfer wealth regularly back to Australia, dollar cost average that currency risk, build wealth in Australia if this is where you intend to retire, return to. Decide what to do on your US property. Are you selling it? Are you retaining it? And what does that actually look like? And of course, model the fact that you have it to always deal with both sides of the fence then. Review your investment cost basis for that deemed acquisition, document it, keep that record, keep those records for future filing. Plan for your retirement accounts as well. That's obviously a huge takeaway for today is your 401k, traditional IRAs, Roths. They're not treated the same here in Australia. So understand how they are treated and understand what you need to do before you come back, because once you're here in Australia, it gets a whole lot complicated. Last one is a bit more of, I suppose, your landing obligation. So come back, consider what you're doing back here in Australia in terms of opening bank accounts, getting car registered, getting leases, actually having the money to fund that, streamline your banking as well. So consolidating cash, typically we like to retain one US bank account for ongoing obligations. Try your luck. Sometimes they just give you the boot anyway because they don't like non-resident aliens holding US bank accounts. Beautiful. I think that's my last slide there, James. I'll give it back to you, mate.
That was great, Martin. So, some terrific insights there, and obviously, running through those three phases. Lock in your timing. As Martin said, that's one of your most important controllables. That timeline upon which you're going to repatriate. Tidy up those assets before you come back, especially given how the Australian side is going to tax them and whether you need to make any withdrawals or move some things. Even use the unrealized losses that you might be carrying because you're going to lose them when you're back in Australia. Plan the currency move. As we said, dollar cost averaging. It's the most sensible approach you can take when a lot of your wealth has been built up in, say, the US dollar, but you're returning back to Australia. And then obviously re-establishing yourself back in Australia, your new home, super, investment structures, and obviously the right debt mix as well. Some terrific insights there from Martin. We're now going to hand it over to Josh, who's going to keep walking us through the exit tax side and unpacking it for us. Over to you, Josh.
Thank you very much, James, for the introduction, and thanks everyone for joining us this morning. My name is Joshua Ashman, and I'm the Managing Director of Expat Tax Professionals. We specialize exclusively in U.S. international tax, and over the past 15 years, we've helped many foreign nationals who have lived and worked in the United States navigate the move back home. Today, I'd like to focus on one very specific topic: what Australians with U.S. green cards need to know before moving back to Australia. Many people assume that once they leave the US and hand back their green cards, they are finished with the IRS. Unfortunately, this isn't always the case. There is a set of rules known as the US exit tax rules that can apply when someone gives up a green card. The good news is that with proper planning, many Australians never have to pay it at all. Over to the next slide, please. The first question I ask a client isn't how much you are worth. It's actually much more fundamental than that. Does the US exit tax regime apply to you at all? Before we talk about net worth, tax liability, or calculating an exit tax, we first need to determine whether you're even within the scope of these rules. If you look at the timeline a second, for Australians moving back home, this is often the most important planning point. The exit tax doesn't apply simply because you have a green card. It applies only if you're considered a long-term resident, an LTR, for US tax purposes. A long-term resident is someone who has held a green card in at least 8 of the last 15 tax years. And here's where many people get tripped up. It's not 8 anniversaries. It's not 8 full calendar years. It's 8 tax years. Even if you held your green card for only 1 day during a calendar year, that entire year generally counts as one tax year. So years 1 through 7 are generally outside the exit tax regime. Once you move into the 8th tax year, you've crossed an important threshold. That doesn't mean you'll owe exit tax. It simply means we've now entered the regime where we need to ask the next questions. If you see in the planning note at the bottom, imagine you've accepted a role back in Sydney, you've sold your house, the kids are enrolled in school, you booked your flights. If you only start thinking about these rules at that point, many of the planning opportunities have already disappeared. That's why we encourage Australians planning a move home to seek advice before surrendering their green cards, not afterwards. Next slide, please, James. So let's assume you've crossed that first threshold. Does that automatically mean you'll pay exit tax? Fortunately, no. There are 3 additional tests, and you only need to satisfy one of them to become what's known as a covered expatriate, or an expatriate that is subject to the exit tax. The first is the net worth. If it's over US $2 million, you satisfy this test. One thing Australians often underestimate is what counts. It isn't just your US assets, your home in Australia, investment properties, your super, your US retirement accounts, everything worldwide is included. The next is tax liability. The second test looks at your average US income tax over the previous 5 years. For 2026, that's approximately $221,000 per year. Importantly, though, that's the tax itself, not your income. Many people confuse the two. The third and final test is the certification. This is the one we see the most often. You must certify that you've complied with all of your U.S. tax obligations for the previous 5 years by filing Form 8854. If you can't make that certification, you're automatically treated as a covered expatriate, even if your net worth is well below the $2 million. This is one of the reasons we encourage clients to become fully compliant before thinking about giving up a green card. This can include taxpayers who have faithfully filed their U.S. tax returns each year, but inadvertently failed to report certain lesser-known international information returns relating to foreign companies, foreign trusts, foreign bank accounts, or certain foreign investments. This is a common issue for individuals who have used a domestic U.S.-located CPA, who may be highly experienced with U.S. taxation, but less familiar with the international reporting requirements that apply to Americans living abroad or those with foreign assets. So let's assume you are a covered expatriate. How is the exit tax actually calculated? Next slide, please. The easiest way to understand the exit tax is this. The IRS pretends you've sold everything you own the day before you expatriate, even though you haven't. Imagine you own a rental property, you haven't sold it, you haven't received any money. Nevertheless, the IRS pretends you sold it yesterday. That's known as the mark-to-market regime. Fortunately, there is a generous exemption. This year, it's approximately $910,000 of built-in gain. Only appreciation above that amount becomes taxable. Now, to make this Australian specific, one planning opportunity that's particularly relevant for Australians is the basis adjustment available to long-term residents. Many Australians arrive in the US already owning investment property back home. Those assets can often receive a step up in basis to their value when they first became US residents. This can dramatically reduce or even eliminate the exit tax on appreciated assets when they eventually move back to Australia. But property isn't the only issue, though. For many Australians, pensions are the larger concern. Next slide, please. Retirement savings are often the most valuable asset Australians accumulate while working in the US. Unlike capital assets, pensions don't generally fall under the mark-to-market rules. Instead, different provisions apply. In some situations, the IRS effectively treats the pension as though it had been distributed immediately before expatriation, resulting in ordinary income tax. That creates a potential problem because when you eventually retire in Australia, Australia may tax those same pension benefits again, as Martin had described. Without planning, there is the potential for economic double taxation. Fortunately, there are important exceptions. Foreign pensions established before someone became a U.S. resident often receive much more favorable treatment. There are also elections available for certain U.S. retirement plans, such as 401ks, that can defer the tax until actual distributions are made. The important point is that pension planning should always be reviewed before surrendering one's green card. Okay, let's move to some case studies now. Let me show you a real life example. These clients were Australian citizens who had spent many years living and working in the United States. Their goal was simple: move back to Australia and surrender their green cards. The husband had accumulated significant U.S. retirement savings and without planning would have been subject to exit tax. Fortunately, they came to us before making any decisions. We developed a gifting strategy, carefully considering ownership of assets and coordinated the timing of everything. One word of caution, though, gifting is another area where it's easy to oversimplify. What seems like a straightforward transfer can create unintended tax consequences or reporting obligations in one or both jurisdictions. Make sure you obtain advice before making significant gifts across borders. In this case, though, the end result was that both spouses were able to surrender their green cards without triggering the exit tax, while also avoiding unintended gift tax consequences. A good result. Next case, please. Next slide. The second example highlights a different planning opportunity. These clients also intended to return home. In this particular case, it was to New Zealand. At first glance, everything suggested they were caught. Their combined wealth exceeded $4 million, and it appeared they had crossed the 8-year threshold. However, after reviewing the treaty position, we concluded they should properly be treated as non-US residents for tax treaty purposes during the relevant year. That meant they never actually became long-term residents for exit tax purposes. In this case, we documented the position in a detailed memo, filed the appropriate treaty disclosure, and fully explained the position to the IRS. The result was that they avoided the exit tax entirely. So sometimes the biggest tax savings isn't finding another deduction, it's realizing that the tax, never applied in the first place. Okay, next slide, just in closing. So if there's one message I'd like everyone to leave with today, it is this: don't wait until you've booked the flights back to Australia. The vast majority of successful exit tax planning happens before someone gives up their green card. Once the green card has been surrendered, though, many of the planning opportunities disappear. If we have 6 months or ideally a year, we can review your timing, your pensions, your worldwide assets, treaty positions, and gifting opportunities to determine whether the exit tax applies at all, and if it does, how we can legitimately minimize or avoid it. Hopefully, this is giving you a better understanding of how these rules work, and more importantly, why early planning is so valuable. Thank you very much for your time, and I'd be delighted to answer any questions.
Beautiful. Thank you so much, Josh. There were some great insights there. We've got a number of questions that have come through, so I'm going to try and condense some of these and summarize them because there's a lot of overlap with some of them. I can see there's a question here which has been submitted by Russell, David, and Melissa, which all overlap. So I'll frame it up. This is a good question for you, Josh. So I'll just read it out as it is. How are tax residency and taxation affected if I relocate back to Australia but continue working for a US employer receiving US wages, stock compensation, retirement benefits, or occasionally traveling back to the US for work?
Okay, that's a good question. Let's assume for a second that these taxpayers are no longer residents in the US. That being the case, generally income is sourced, which means the country is given the right of taxation based on where the services are performed. So again, in our scenario where perhaps they're no longer US residents, they're no longer working in the US, then technically they would be exempt from tax on the income in the US. However, I will note that the US payroll may continue to withhold taxes, both income taxes, social security taxes, maybe even state income taxes. So that's definitely something you want to look at to try to organize with your employer, with the payroll department, to perhaps adjust the amount of withholding to prevent the situation where there's a cash outlay, there's withholding taxes, and there's taxes due in Australia because that's where the work is being performed. So in a sense, you've paid tax at source, you're estimating your taxes in Australia, and then you're left with very little cash to go with. So it'd be very important to identify which country in that case will have the right of taxation, and then work with the payroll department, filling out the correct withholding certificates to try to avoid a situation where there's a even if it's not an ultimate tax, an ultimate double tax, but work out a situation where you can be in a better position to plan your cash and avoid some unnecessary withholding.
Yep. Good question. This one is, I think, probably an easy one for Josh here. When does the US exit tax apply to Australians that are on an E3 visa but have lived in the US for more than 8 years?
The good news is it wouldn't. The exit tax would not apply to someone who was in
Yep.
the US,
Yep.
who was a resident alien based on substantial presence, but who did not have any immigration status like long-term residency or like permanent residency.
Yep. And that's so crucial. We often interview and do a lot of consults, discovery consults with Australians that have been in the US for a number of years, but they've only ever been on an E3 visa. So the exit tax isn't really a concern for them. It's mainly obviously permanent residency, green card, or US citizenship. That's the issues that can lead into those other tests. So that's a good one. Another question here around California and state tax residency. This is from Russell Yu. Can I remain subject to Californian state tax after moving to Australia? And what factors can determine whether I'm still a state tax resident?
Yeah, this is a good question. Again, I'll jump in with an answer.
Mm,
One, I think overriding principle, something to keep in mind is that the particular states, in this case California, are not bound by any of the treaties that are negotiated on the federal level, on the IRS/ITO level. So that means that determining whether one continues to be a resident in a particular state is very, very state specific. Each state has their rules, who's considered to be a resident. Some states it's based on physical presence. Some states it's based on a much more um, domestic type of test known as domicile, So, each case needs to be looked into. But what's clear is that as you're planning your move from, let's say in this case, California, it is important to make sure you're taking steps to disconnect yourself from California domicile because California is a domicile state. That means certain personal connections, business connections, like voter registration, car registration, memberships, et cetera. So domicile will really drive, in California's case, whether or not you're considered to be a resident. One thing that will be important, although maybe simple in a case of someone moving back to Australia, is you'll definitely need to establish domicile elsewhere before you're
mm,
able to terminate domicile in California. But if that's done properly with some proper planning, you can avoid. There are still some sources of income that will remain taxable in California. One of the examples we gave today was owning a US property and renting it out. If that property is in California, that'll continue to be considered subject to tax in California. Also around equity compensation, certain instances of RSU vestings and
mm.
things of that nature can also remain clawed back, or that tail can remain with California for a while too. So very important to analyze the assets, of course. Very important to plan the exit and the termination of domicile to try to avoid California. But states like California are very aggressive. There are other states too, which a lot of people
Yeah.
move to for work purposes, like Massachusetts and New York, California, et cetera. So yeah, it's a good question. It's very different than what was talked about tonight, which was much more focused on a federal level. But at the same
Mm.
time, with proper planning, can be optimized.
Yep. Good question there. Another question here, I might throw this one over to you, Aman, from Alice. Can Australians continue to hold and operate US brokerage accounts such as E-Trade or Fidelity after returning home? And then second part and follow-up is, when would a platform such as Interactive Brokers be preferable?
Good questions. Very, very common. I think yes and no to that answer. So can they
Mm,
continue to hold it? Yes, typically. Can they continue to operate it? Not always. So, use Fidelity as an example. Typically, they will allow you to continue to hold it, but you won't be able to continuously invest and trade on the account as a non-resident alien. So, you do have to look into that, speak to the platforms that you have, your existing brokers, and determine whether or not they are actually suitable for the expat space. Interactive brokers, yep, they could be a good option there. One of the main ones that I think a lot of our clients use, and we've seen some good success through, is Charles Schwab International.
mm,
Just that they're a lot more flexible than someone like Merrill Lynch or E-Trade and Fidelity and so on. So yes and no to that. There are some platforms that will accept it. There are some that will restrict it. I haven't really come across any that have just blatantly said no if you've already got funds there.
mm.
But yeah, definitely look into it.
Yeah, I think Interactive Brokers as well, it's not the best user experience.
Mm,
We've had a number of clients that have held assets on there, and when they come back, the customer support they get from Interactive Brokers, just the headquarters, is usually pretty awful, to be honest. It just becomes a good tool to hold. Maybe doing some currency transfers can be okay as well, but there are certainly some restrictions that can be applied to it. That's for certain. I think also, if you're coming back and you're going to continue holding some sort of assets on these kind of accounts, I've seen Josh mention it before, but probably making sure you're submitting things like a W8 bend form and making sure they're,
Mm.
treating you as a non-resident alien. And I think that probably extends to withholding taxes. Is that right, Josh?
Yeah, that will ensure that they're going to apply the withholding taxes properly, which will negate an obligation to continue to file a U.S. return. If a
Mm.
non-resident has investment income, let's say dividends or even capital gains and some
Mm,
interest, if the withholding is done properly in accordance with the US-Australian tax treaty in this case, then actually there is no obligation to continue to file a tax return solely to report that investment income. If, however, they're either not withholding, which is improper, or they're withholding
hmm
too much. The US
Yep.
standard withholding rate is 30%. But
Mm.
for example, on dividends under the US-Australian tax treaty, it's only 15%. So if they're withholding 30%, then if you want to get back the withholding, then you'll have to file a tax return to make that claim. So by submitting a W-8BEN, confirming your residency as an Australian, the financial institution should apply the correct withholding rate, dividend
hmm
15%, zero on capital gain, zero on interest, in which case, you're good to go. No need to file, no need to claim, no need to report.
Yep.
So that's something I think that those that are leaving the U.S. tax net or moving abroad, they like to stop filing. They don't want to continue to report to the IRS. So this is the way to do it to make sure you have the withholding certificates up to date as properly.
Yeah,
Yes,
I agree.
I agree. I
Keep it
think
simple.
I might add one comment there is making sure that the platform accepts it. Sometimes
Yes.
platforms do not accept it at all, and it's simply because they don't really gain anything from it. If they stuff it up, then it's on them, and they're going to cop it from the IRS. So, working with a team and working with a platform that is more expat friendly and confirm and apply the correct withholding tax is really important, and that comes down to how you fill out that W8 BEN as well. So yeah, definitely do that and work with someone, a platform that is more expat friendly.
That's a good point.
Yep. Yep. Good question there. We've got two questions here, which are sort of looking at from, I guess, either sides of a different lens. First question from Michael Corbett. Thank you for this one. How does Australia's deemed acquisition cost-based step-up work when becoming an Australian tax resident, and does it apply to shares, ETFs, and cryptocurrencies? I'll let you handle that one, Martin, and then I'll send the follow-up question to Josh. I'll repeat it after. So over to you, Martin.
Yes, well, it does apply to shares, ETFs, managed funds. Basically, deemed acquisition, the day that you become a tax resident, becomes the new floor or the new cost base for those shares. So, as I mentioned, it's a bit of a double-edged sword. So, if you've got a large unrealized capital gain, that's fantastic. But if you've got a capital loss or some losses that you haven't yet harvested, then it might be time to do that beforehand because you're not going to get that benefit here in Australia. That basically becomes your new floor, and then gains from that point onwards, if you sold them down, would be taxable here in Australia. So applies on your worldwide assets. The only sort of, I suppose, caveats I would apply to that, it would be anything held inside of something that would fall under a foreign investment trust. So,
Mm,
the Roth accounts, or potentially if you have it held through a living trust as an example. So that just requires a bit of extra attention.
yep, good one there. So on the other side of this question is pretty much the same question, but does the US have a corresponding tax event? So does the US have a deemed acquisition type of event when becoming a US tax resident? So looking at entering the US system, I guess.
That's a good question, and it is one of the areas that the US and Australia do not align. There are
Yep.
several, and this would be one of them.
Mm,
There is no automatic deemed acquisition or rebase of assets when becoming a U.S. tax resident. There are ways to accomplish that, okay? But it's not the same as Australia in that it's not automatic just because residency is triggered.
yep. Yep. Question here around selling a former US primary residence, which turned into investment property. So good question, Oliver. What are the Australian and US tax implications of selling a former principal residence that became an investment property before returning to Australia? So I'll look at this from the Australian side. So unpacking that question, it sounds like you had a main residence in the United States, which you then turned into an investment property, and then you returned back to Australia and then maybe sold it. So if you're an Australian tax resident at that point of time, you can actually use the main residence exemption. A couple of caveats to that is that you do not have another property in Australia, which is your main residence previously. If you don't own any other assets, property assets in Australia, then you can use this 6 year temporary relief rule where you can own essentially a former main residence and rent it out for up to 6 years, and you do not accumulate any capital gains tax on that asset. So if you're selling within that window of 6 years of when you first rented it out, because the ATO would look at that, then you're completely fine. It actually would be a tax-free transaction. And that is just using the main residence exemption from the Australian side. We often have sometimes this scenario play out where a client might be repatriating, but it's taking them longer to sell their former US main residence. So they're back in Australia, but it's taking for some reason 6 months to offload their former US main residence, but they haven't actually purchased or established a new main residence in Australia. So in that instance, they're just using the main residence exemption. That's fine. You can also, within the legislation on the ATO side, you can technically have two main residences for up to 6 months, technically, but you can't really game that. You can't sort of play with the rules there. You just need to be mindful of that. That's how it'd be treated on the Australian side. I'll then kick it over to Josh, just unpack the US side.
Yeah, on the US side, it's a little bit different. It's that 2 out of 5 year that I think either James or Martin had mentioned during the
Yep.
presentation.
Yep.
The investment property can still be considered a principal residence and eligible for the $250,000 exclusion as long as that the ownership and use of the property has been met by the taxpayer for 2 out of the previous 5 years. So that's the window. That's the window that's required to sell the property within in order to be eligible at all for the exclusion. One thing I will point out, though, is that generally during the period of investment, the period of rental, you're going to claim a depreciation as an expense, for example. That's one of the ways that you reduce your tax on the rental is you have the gross income and then you have your expenses, including depreciation. So that depreciation is a recovery of the original investment cost of the property at about 3.6% a year. So however much depreciation had been claimed or even eligible to be claimed during the period of investment or the period of rental, that will be recaptured and taxed, despite the fact that the capital gain can still be offset, assuming you qualify up to that $250,000 exclusion amount. You'd still have to pay tax on this depreciation recapture, which is just the IRS's way of tempering the overall benefit of the depreciation, which gave you a ordinary income deduction. They require you to recapture that when you sell. So a little bit technical and nuanced. So I guess just to summarize in a nutshell, as long as you meet the 2 out of 5 years, you can claim an exclusion on the capital gain. However, the depreciation will be recaptured. So there could be still some US tax to pay.
One there. Another question here. We've got about three questions which are sort of along the same line. So I'll see if I can paraphrase and consolidate these. So I appreciate these, Alice, Tim, and Mark. Can I continue to hold US bank accounts and credit cards? And is there any banks that you would suggest that are expat friendly once we have come back to Australia? So expat friendly US banks. So good question. I mean, Martin, what are your thoughts on this one?
I mean, you can try. I don't think they generally like it if you're a non-resident alien, but it will take a while for them to kick it off. You should probably try to at least keep one account active. I couldn't point you to one preference. It's really a hit and a miss, at least from my client's experience. But if you have a 401k or you have Social Security that you're drawing down, or even a US brokerage account, typically you need to have a USD account to actually receive those funds into. So we have come across issues in the past where someone has lived in the US for, 20 years ago, they're back in Australia, then they've become eligible for Social Security after meeting full-time retirement or want to draw down from a 401k, and they don't have a local bank account. No bank over there is going to allow you to open one as not a US permanent resident or US resident, tax resident without a Social Security number. So
Mhm.
they have this issue where they have to sort of get a check mailed to them. But there is a solution, and I'll give you that one for free for all the listeners. It's a bit of a wise using a Wise currency account because they have actual branches in the US. You can use that, and because the account name operates under your actual name instead of Wise, that means that usually that's accepted from brokers, from 401k providers, and even Social Security to actually receive those funds in US dollars, and then you can move it across. So I don't have a specific recommendation on which bank, but Wise is maybe a good alternative solution, and just check before you go, I suppose.
Mm. Yep. Yep. Question here from Amir, just about US Social Security. How are US Social Security benefits treated for Australians who retire in Australia after working in the United States? So that was a good one that I guess on the Australian side, I'll answer this one and I might give it to Josh on how it might be taxed in the US. But on the Australian side, this is the great thing about our treaty, the double taxation agreement between the United States and Australia. It's not actually taxable in Australia. You don't need to report it on your Australian tax return. It's probably one of the good things about our treaty, to be honest. So not reportable. We've got a number of clients receiving US Social Security as a general income supplement to their overall retirement. But yes, not taxable on the Australian side. Josh, how would this be taxed on the US side if they're back in Australia and no longer living in the US?
Yeah, it is still taxed. It's taxed at source. There's a withholding tax that's applied. It works out to 25.5%. It's that 30% standard US withholding on 85% of the benefit. So yes, while there's a benefit on the Australian side under the treaty, the US does retain the right of taxation, and the Social Security Administration will take 25.5%.
Yep. There you go.
I might add,
Go on.
might add just one more point to that on the Australian side is, remember that counts as income if you are looking at age pension tests. So it will count towards that as well. So just bear that in mind. Just because it's tax-free doesn't relieve you of everything, assuming that that's what you're going for.
Yep. Go on. Another question here. I'm not sure if we can answer this one from Paula. It's around US Medicare eligibility. Can former US residents continue Medicare coverage and access US healthcare services while living in Australia and periodically visiting the United States? I'm not sure if we've got the brains trust for that question. Any thoughts?
Yeah,
Not
it's
for
not
myself. I
my
don't know,
yeah, not my
Josh.
area of
Yeah.
expertise with the Medicare. I think it's still eligible, but probably
Yep.
best to speak to someone that specializes in that.
Yeah, we love throwing a curly one to the Brains Trust.
That's
That's a good
good.
one, Paula. Um, we'll try and stay in our lanes. A good one here from Alice, centering around IRA accounts. So, should Australians generally leave traditional IRA accounts invested until retirement? And are there circumstances where alternative strategies should be considered with withdrawing? So, I think Martin sort of addressed this a little bit, but Martin, what were your thoughts about whether they should take it when they leave or whether they should keep it invested until retirement? What's your take?
The famous response is it depends, because it really does. It depends on your personal circumstances. There's pros and cons for each. As an example, if it's a low account balance and you're younger than the age of 59 and a half, sometimes it's worth copping the extra 10% penalty tax that you pay and then using that extra surplus to fuel and fund a different strategy back in Australia, whether that's to help you get on the property market, that's to manage your cash flow, pay down debt, or potentially add it to your superannuation where you pay 15% tax going in, but then you get to claim that contribution as a tax deduction outside of super. So if you're taxed at 47%, you could potentially be saving 32% Australian tax just by wearing an extra 10% in the US. For larger account balances, though, I mean, yeah, usually it makes the most sense to delay it until you're over the age of 59 and a half, drip feed it out, manage both sides of the tax regimes there and the tax systems submit the W8 then, get all those boxes ticked. There's also things you can do before you come back to Australia to, if that's the plan that you've done, to alleviate some of the future Australian tax considerations. So then we're mainly dealing with the US side.
Yep. Yep, good one. I only got a few more questions, so I thought I'd just jump over the slide in the event you guys need to reach out for some advice, and I'll be sharing Expat Tax Professionals website very soon, so you can jump on there also. But that was a good question, Alice. One from Anonymous, so not putting their name to the question, that's probably wise. What ongoing US tax filing obligations apply to dual Australian US citizens who permanently reside in Australia? Good one for you, Josh.
Yeah, unfortunately, a lot of ongoing compliance is required, and things get pretty complex once you are in this international arena. With respect to Australia in particular, the topic of today's discussion, I would say that there are many areas where the systems align. There are many areas, unfortunately, where they don't align. So things around PTY limited companies were talked about today. Certain investments in non-US ETFs, mutual funds, can also trigger enormous, compliance obligations and some onerous results. Foreign trusts for sure, Australian discretionary trust, family trust. So yes, um, it's a cleaner break when you have either a resident alien that's leaving Australia or even a green card holder who's planning to properly exit the US tax system, avoiding exit tax. The American citizen, the dual US Australian citizen, will continue to have this obligation and will really need to navigate things properly to avoid some mishaps and potentially double taxation inefficiencies. So I would very much recommend that that person, anonymous, to seek a good professional help from someone who understands both sides of the system and can coordinate that properly.
Yeah, absolutely. We'll close it out with two more questions. This one we might have actually just addressed, but I'll just read it out from David. What happens to existing 401k accounts after returning to Australia? And what should be considered before making withdrawals? So, Martin, might get you to tackle that one first.
Yeah, sure. I mean, reiterating a lot of the points that we've already made today. So what happens, sorry, was it before or after, James? Sorry, I missed that.
Yeah, what happens to existing 401k accounts after returning to Australia?
After. Yeah, yeah. Well, the business as usual, they will just continue to tick along. As I mentioned, some platforms are more expat friendly than others, so it can pay to move on to a more expat specific type of platform or expat friendly one. If you're making withdrawals, you pay taxes in the US, you submit the W8 ban. Ideally, you can get that withholding brought right down. In Australia, corpus earnings, Section 99B treatment applies here. So understanding if I draw out X amount from my 401k, how much am I paying here in Australia? Can I reduce that in any manner? And I suppose, going back to Alice's question as well, what bank accounts are suitable? Consider keeping a US bank account or maybe using that Wise account as a bit of a trick there. But yeah, reiterating a lot of the points that we've already made today.
Yep. Yeah, and just the last question here, mainly one for Josh. How are RSUs and equity compensation taxed when I return back to Australia but leave them in the US?
Yeah, so if they're fully vested and the RSUs have already been released and you're holding the RSUs as stock, then we'll talk federal. Again, each state
Mm,
might have a different way of looking at it, but just from a federal tax level, at that point, your any additional appreciation will be considered capital gain. That would generally be exempt from tax in the US if we're talking about a non-resident who spends less than 183 days in the US. There's some conditions there, but let's talk high level. Capital gains earned on US securities by a non-resident living outside of the US is going to be exempt. So an RSU that's fully vested, those will generally be exempt from tax in the US. If vesting has continued or it continues, then and the compensation component of the RSU has not yet been taxed. Upon vesting, there may be a portion that's still subject to tax in the US. If, for example, half of it had vested while you were a US resident, half of it had vested when you were non-US resident, and then the vesting is completed, then 50% in that example would still be considered subject to tax in the US upon vesting. And that means that even if you're a non-resident at that time, you would be subject to tax in the US. You need to file a non-resident tax return. It's likely that the employer will continue to issue a W-2 for that compensation amount. They may even withhold tax on that compensation amount, which is correct. And then you would file a tax return making sure to include only the US portion of the vesting. That's generally how it works with RSUs.
Yep. Yep, good one there. Final comment from Anonymous. Will you be doing more webinars like this, which involves and is specifically tailored for dual citizens that are returning back to Australia? So yes, we will be. We've got Josh on. We put him in the hot seat, so we are going to get Josh back on another time over the coming months, and we'll try and tailor another one specific around this. Not necessarily exit tax, but maybe just more around US taxes, dual citizens, those sort of considerations, especially as the tax year winds out for the US side once more. That is it from all of us today. Joshua, Martin, really appreciate your time this morning to run through what's been obviously a pretty technical topic to unpack. So if something has resonated with you today, please make sure you reach out to Expat Tax Professionals or Atlas Wealth. In the meantime, guys, really appreciate your time.
Thank you.
Cheers.
Thanks, everyone. Speak soon.
Bye-bye.